Hi, this is Ron Rowland with Money Markets TV. If you haven't filled out your income tax return yet, that day is almost here. Millions of Americans are sweating right now as they frantically sort out deductions, credits, and amortizations. Exchange-traded funds can help reduce those tax headaches. Today, I'll explain how they do that and try to answer a couple of common ETF tax questions. But first, let me remind you, I'm not a CPA, and I can't give you personal tax advice. I'm going to cover some general principles, but you should consult a professional about your own situation. Generally, if you realize a profit from your ETF investments, you'll have to report it as income. These capital gains are taxed in the year that the ETF is sold, which may be different than the year you bought your ETF. This is one of the prime arguments in favor of long-term investing. You don't have to pay tax on a gain until that gain is actually in your hands. This is often not the case, though, with mutual funds, which make capital gain distributions to shareholders, so that the fund itself doesn't have a tax liability. But the ETF structure largely solves this problem. However, there are always exceptions to the rule. One common scenario is when you own an ETF or mutual fund within an IRA, 401k, or other retirement plan. Generally speaking, your tax liability will be deferred, though not eliminated, until you withdraw the profits. Another exception has to do with ETFs that use futures and other derivative instruments to implement their strategies. This is the case with many commodity and currency-related ETFs. If you own any such products, or if you have a retirement plan, you may get a mysterious form called a Schedule K-1. Most commodity and currency funds generate their returns by holding futures contracts. The IRS requires these funds to be marked to market at the end of each year, at which time any open gains or losses are apportioned to investors. This means the K-1 can show gains even if you didn't sell any shares. Gold funds are another special case because the IRS taxes gold as a collectible instead of as an investment. So pay special attention to the forms you get on your gold holdings. Master limited partnerships are even trickier because of the various state tax liabilities where the MLP operates. And off-the-shelf tax software might not fully alert you about these state taxes. MLP exchange-traded notes, or ETNs, largely solve this problem by issuing 1099s, but their distributions are not tax-deferred. One other exchange-traded fund that specializes in this type of investment is the Illyrian MLP ETF, ticker symbol AMLP. It's structured as a C corporation, which allows it to make distributions that receive favorable tax treatment. And it also issues a 1099 instead of a K-1. The problem is that C corporations have to pay the 35% federal corporate tax rate, plus various state taxes. In other words, you have to give up about 35% of your capital gains so that the ETF can pay its taxes, and then pay your own tax bill on top of that. For me, that's much too high a price to pay for tax-deferred distributions. The bottom line is that if you invest in ETFs, you could have a range of challenges in preparing your taxes, especially since some funds issue K-1s while others use the more common 1099. Your best solution might be to get your tax return prepared by a professional. Otherwise, you just have to hope that Congress someday gives us a simpler tax system. I'm Ron Rowland for Money and Markets TV. Thank you for watching.